Tuesday, October 11th, 2016, Maneco 64, home of alternative economics and contrarian views. I'd like to give an update on the U.S. Treasury market, which is the base of the global bond market. And why do I say that? Well, U.S. Treasuries are considered to give investors a signal of the risk-free rate of return, which sounds a bit, strange because I personally don't think they're risk-free, but that's how the markets work for now. So, and what do I mean by the risk-free rate of return? Well, that's the interest rate that it's expected from an investment that is supposed to be safe. Investors expect the U.S. government not to default, and de facto they haven't, because they can always print the paper to pay people. But well, de facto they have, but de jure they haven't. That's what I meant. They pay people with paper that has less purchasing power throughout the years. So they have been defaulting for years, and they defaulted also in 1971 when Nixon closed the gold window. So that's a different subject. So the reason I want to talk about U.S. Treasuries and the bond market is that back in July, we reached basically all-time lows in U.S. 10-year yield, around 1.35%. And when that happens, the prices go up. They're inversely related, bond prices and yields. And there's another part of the bond mechanics, and it's called duration. Duration basically is the amount that the bond price moves depending on the change in yield. And the higher the duration, the more volatile the prices become if interest rates change. And the other thing that makes the duration higher is if the bond has the maturity is longer term. So with the policies we've had the last 8 years of zero interest rates, QE to buy treasuries and other government bonds, that's driven interest rates lower. People have been buying bonds, to lock in return, higher yields, but that drives the yields lower. And investors have also been forced to buy longer dated maturity paper because they usually yield more, and that's driven those yields lower. Even I think it was Italy the other day, they issued 50-year paper, and investors bought into that. But what that does is that increases the duration of bonds, because also when the price goes up of these long dated paper and the yield goes down, the duration goes even higher. And investors have been doing this, and speculators as well have been buying into this because they think the central banks have their back, and they think the central banks can control these longer term interest rates. And I think they're wrong, because a central bank's balance sheet is compared to global financial assets, it's not a huge percentage. So the markets in the end really control bond prices, and central banks can try to influence interest rates. They have more power to influence interest rates in the short maturities. So what's happening now is that I think, and I'm not the only one, because in July I made a video saying, is this the top of the bond bull market? Because we've had a bull market in bonds since 1981, 35 years, and yields have been, going down. Duration has been going up. And I saw that Ray Dalio, who's one of the biggest hedge fund managers, who manages hundreds of billions of dollars, he said the other day that bonds are getting more and more dangerous because of this policy of QE, zero interest rates, negative interest rates. It's driven duration a lot higher. And if people try to get out of their bond positions now, it's not going to be as orderly, as people expect. And he compares the market now to the bond market in '94. And I remember that year because I was working in the markets at the time, and I worked with bonds, specifically treasuries, bonds, gilts, government bond futures, basically. And I remember that was a horrible year for the bond market. That was the year, I think, that Greenspan raised interest rates a bit, and the bond market just crashed. Stock market didn't crash, but the bond market crashed. You had Orange County in California went bust because they had some derivatives contracts, and they lost their shirt. They went bust. So, and Ray Dalio has basically said that the duration of the bond market, investable bond market right now, and he's only looking at the U.S., is a lot higher than it was in '94. So I think we need to keep an eye on bonds. I know I cover precious metals. Sometimes I look at the stock market. But so looking here at the chart of the 10-year yield, so we got down to around 135 in the beginning of July. And ever since then, we've been making higher highs and higher lows in yields. In beginning of September, middle of September, we traded up to 175, which is like, it's like a round figure. Yields, you have 1, 1.25, 1.5, 1 3/4, and then 2. So 1 3/4, that was the high in the middle of September. And then we went down again to around just above 150 at the end of September. And then since the beginning of October, yields have resumed higher. The 10-year yield now, let's see, just refresh the screen. We're now at 176. So we are higher than, from what I remember, the high on that day in September was around 175. So we're broken through that level. The high today has been 178. So it looks to me like yields want to go up. And that's in spite of the fact that we've had, weak economic growth in the U.S. In the first half, 1% handle. And for the second half, we've had IMF, St. Louis Fed revised growth forecasts lower. I know the unemployment numbers and jobless claims look great, but do you believe in those? I mean, no, I don't. Labor force participation rate, is at 40-year lows. There's 95 million people out of the workforce. So what this is saying is that in spite of an economy that's sluggish, yields are starting to go up, which is not a good sign. It's stagflation, which is something people haven't heard of since the 70s, I guess. So I'm looking at the 30-year as well, because we reached around 2.5. Well, let's go back to July. We got a low of about 210 in the 30-year. And since then, we've been going up. We got up to around 250 middle of September intraday, 2.5%. And today, we've gone up to 251, and right now we're around 249. So yeah, that's not a good sign. And the other thing that's happening is now the stock market is down. The Dow is down 0.75%, down 140. And back in September, this started to show, you had the stock market dropping and the bond market dropping. And usually in the last, 10, 15 years, whenever you have a stock market going down, the bond markets usually used to rally. that was called the old flight to safety. Now they're saying that this is happening because of some concept of risk parity, but I don't buy that. I just think it's worrying that that relationship is kind of breaking down a little bit here. So I'd like to just warn people. And the other thing I like to show, so the Dow right now is down 140 points at 18,180. The other thing I'd like to show, just technically, the stock market, just bringing the chart up here. If you look at the May high of 2015, that was around 18,360, and now, and I drew this line, that, you know, a line coming from that May high of 18,365 or thereabouts. Of course, we got above that in July, and we stayed above that line up until September, and then we dropped below it. And ever since then, we've been trying to get back above, you know, that May 2015 high. And as you can see, it's the Dow is having a really tough time getting back above that line. Yesterday, we closed just below that level. I think the close was around 18,310. I'm not so sure. But on the other hand, of course, we're holding above 18,000, so there's not much movement. It just seemed to be going up and knocking against that line. And there's another trend line coming from the all-time high there in the middle of August, and that hasn't been broken yet. So interesting times with the stock market seeming to have a tough time, you know, resuming its move higher. Basically, we've been in the same place since May 2015. If you think about it, we haven't gone up or down from that level. So gold, 1255 right now, is down about 4. Silver, 1750. Currency is still suffering a lot here, especially sterling. We're down 1% now at 122.30. And in the gold price in pounds is 1,026, which is doing well, protecting sterling investors. So yeah, that's it for now. I'm gonna keep an eye on the U.S. Treasury market or interest rates. I think that's very important, and we'll see if this is, you know, just a storm in a teacup, or, you know, a harbinger of something, you know, that could develop into some kind of market event. I don't know. So if you enjoy my videos, please like, share them, and subscribe to my channel if you haven't yet. And if you'd like to donate to my channel, there's some links below in the description. Thanks for watching. Bye.